I refuse to answer that on the grounds that I don't want to.
Okay, let's look at IPOs. It's the financial world's equivalent of a Broadway debut or whatever hacky metaphor you want to make. A company that was once a scrappy private entity, maybe a startup with burning VC money, or maybe an old school family business. It suddenly becomes publicly traded. Its stocks are available to anyone with a brokerage account and an opinion. This is exciting, but it's a lot of work, which means it's a lot of money to pay a lot of people to do the work. There's paperwork, and where there's paperwork, there are lawyers.
Mike Ross for the plaintiff, Your Honor.
A. Elliot Stemple for the defense. What are you doing here?
There's also the investment bankers and expensive suits explaining why the stock should be priced slightly lower than the company wants. For the company, going public means raising capital, providing liquidity for investors and employees, and getting that coveted stock ticker symbol. But it also means regulatory headaches, quarterly earning pressures, and the joy of anonymous internet commenters speculating about your business strategy. There's good reasons to do an IPO. There's raising capital. You could get more money to expand, pay off debts, or just fill the bank accounts with billions of dollars because, seems like a good idea. There's liquidity for shareholders. Early investors and employees who want stock options might want to finally cash out, and this gives them a chance. There's public currency. There's a reputation. Once public, a company can use its shares to make acquisitions or attract talent with stock-based compensation. Again, there's a prestige element. It's a signal for legitimacy. Your company gets analyst coverage, a bigger profile, and maybe even a segment on CNBC.
Isn't there a metal briefcase full of bearer bonds handcuffed to your drinking arm?
Pretty sure you just answered your own question.
But there's downsides. There's regulations. Public companies file quarterly 10Qs and annual 10Ks and report to the SEC. Plus, they have to comply with all these other regulations like SOX and whatever governance rules. There's stock price pressures. The market wants growth. If quarterly earnings disappoint, investors will let you know by selling your stock. There's public scrutiny. Everything from executive pay to business decisions that get analyzed and criticized. Now, retail investors, they're very opinionated, especially on Reddit. This is why some companies delay going public and often instead opt for, venture capital or private equity funding. But eventually, many still opt for IPO status, for capital, liquidity, or just, they think it's the right time.
Take a swing and see what happens. I didn't think so.
So let's break it down. How and why does a company go public, and what actually happens in an IPO? I'll give you the lawyer side of things in more detail, and I'll show you what's arguably the most exciting part about being a capital markets lawyer.
Harvey, what's going on with you?
Nothing's wrong. I need a glass of water.
Okay, there's a few steps. First, you got to assemble the team. The company hires the investment banks, the underwriters, they run the IPO process, they price the stock, they sell it to investors. Now, banks want to be on this deal to make money, so a lot of banks are kind of competing to be the bank that takes you public in what's called sort of a bake-off. Then you have the lawyers. The company has its own lawyers, issuers counsel, and then the banks have their own lawyers, underwriters counsel, and they ensure everything, follows securities laws and negotiates all the deal elements from the legal side.
To a zone which is one of danger.
You also have the auditors. Company need clean, audited financial statements. If they're not in good shape, an IPO could be delayed. The team starts off by a kickoff meeting. So all the parties, they get together, they discuss, how's this IPO going to be structured? What are we going to do about the sort of project management aspects of financial reporting, all the disclosure documents. Are there potential legal issues? And how are we going to frame the company's story for investors? After the kickoff call, you usually start diligence and writing the prospectus, which is the main document that goes out to investors that describes the company as well as the shares and stocks or whatever the initial public offering is offering. And it has to comply with the security law requirements. And there's also a lot of filings that go into it, an S1. But the real work starts with due diligence. Lawyers and bankers, they review everything about the company. The financials, the contracts, the legal risks, the intellectual property. The goal is to uncover any red flags before the investors do. Now, the prospectus, it's one component of a larger filing, the S1, the registration statement, which has to be filed with the SEC. And the basic elements are sort of the business overview, what the company does, the risk factors, a long list of what could go wrong, the use of proceeds, what the IPO money will be used for, the financial statements, the audited financial statements with footnotes that nobody really reads, and what the SEC demands in this S1 form is that companies are truthful. They're disclosing everything fully. And there's a bit of back and forth with the banks and the lawyers. And maybe the company as well. The lawyers want to make sure that the S1 is accurate. The bankers want to make sure that it's persuasive to investors. You kind of need to write the registration statement in a way that's compliant but persuasive. One way to do this is having the junior lawyer check every number and statement to tie out that it's legit, and by sort of, blunting very ambitious statements like, we're the best company ever. You want to change that to an opinion, like, we're one of the best companies in our opinion of the people in our industry, blah, blah, blah.
A giant hand has turned my dial from half-ass to quadruple ass.
Okay, the third part is you have a draft of the S1 or the registration statement, and then you send it off to the SEC. The SEC is going to come back with a bunch of comments because they're never happy with stuff. The SEC reviews it, they come back with comments and questions, and the lawyers and bankers and the company go back and discuss how to revise it. And then you amend it, file it again, and then this back and forth happens, multiple times over weeks and months until the SEC is satisfied. There's also strict rules on public statements. The company can't hype the stock before the SEC gives the approval. If the CEO accidentally says we're going public and we're going to crush the competition, that's gun jumping, which, again, could delay the deal.
It's not your shit.
Half of it is.
Because I had a shitty divorce lawyer.
Whose fault is that?
Now, the roadshow, what the bankers do to sell the stocks, the company's executives, the CEO and CFO, as well as the underwriters, go to meet big investors, mutual funds, hedge funds, and pension funds. They present why the company is worth investing in, and they take questions. Underwriters use this process to build a book and figure out who wants to buy the shares and at what price. Throughout the roadshow, this sort of demand is tracked, and if everyone wants the stock, they might increase the price. But if demand is weak, they might, lower the price or even delay the offering altogether.
You need me around because you want the excuse to be your worst self.
The night before trading starts, the underwriter and company do what's called a pricing. They set the final price per share based on the roadshow demand and the number of shares sold, sometimes more, sometimes less, and the allocation, which investors get how many shares. And the goal is ultimately to price it high enough to maximize the proceeds, but low enough that it ensures a stable debut. If the stock jumps too much in one day, it kind of suggests that maybe the company could have raised more money. The big day. Trading begins on the morning of the IPO.
Wind toast?
It's 9 o'clock in the morning.
Yeah, and champagne is like the breakfast of alcohol.
Now, after the IPO, there's still work to be done. The company is now public. It's filing quarterly and annual reports now, so lots of money for the lawyers. And insiders, the founders, execs, and early investors are locked up for around 180 days before they can sell their stocks so that, it doesn't affect the trading. And if an IPO is successful, the company can raise more capital later on in follow-on offerings. Now, not every IPO works out. For example, in 2019, WeWork's IPO completely collapsed when investors saw its governance problems in the S1. Now, for the company, an IPO is a milestone moment. You only get once. Some CEOs only see this once in a lifetime. For the underwriters, it's a lucrative business. The banks made a ton of money on this deal. For the lawyers, it's just a ton of paperwork, man. But if you love your job as a securities lawyer or a capital markets lawyer, this is what you live for. The thrill of guiding a company into the public stage.
This will be good for our economy. It helps companies raise money. It will promote economic activity.